Yesterday we have talked about introductory part of LKAS 12, that is income taxes, and we have discussed about the under provision of tax, over provision of tax, and its double entries, and how to recognize as deferred assets and deferred tax liabilities. And also we have discussed about the measurement and the recognition of deferred tax assets and liabilities. Today we will discuss a focus mainly on deferred tax and tax basis. So focus on deferred tax assets, so deferred tax and deferred and tax basis. So most importantly we will discuss what's the treatment, so how we can understand the differences between the tax base and carrying amount. So there are different components in balance sheet view, where you have to discuss what is a tax base for an assets, what's the tax base for a liability, what's tax base for accrued expenses and provisions, and tax basis for accrued income and prepayment of revenue. So this kind of stuffs we are going to discuss, so with illustrations. So it's little bit difficult to understand the differences. So anyhow, I do my best, right? I do my best to share my knowledge with you, right? What is deferred tax? Deferred is kind of so postponed, right? So deferred expenses means so that's an expenses we have to make today, we have to settle today, but due to various reasons we postponed the payment of expenditure. So that's called deferred expenditure. So tax, the income tax is an expenditure in the viewpoint of a corporation or entity or business entity. And deferred tax mean postponed the income tax expenditures for future period. So we have studied, we have got well understanding about the differences between accounting profit and taxable profit. Accounting profit and taxable profit. So the calculations are differ among these two way of calculating income, calculating profit. So as we remember, so accounting profit is calculated by following accounting rules and regulations like LKAS, accounting principles and accounting concepts. But the taxable income is calculated based on the provisions and amendments of local tax authorities. As far as Sri Lankan concerned, our local tax collecting authority is Department of Inland Revenue. So the respective the rules and regulations is number 24 of 2017 Inland Revenue Act. So when calculate the profit according to the rules and regulations of tax authorities, then we call it taxable profit. So if there is no differences between the rules between accounting rules and tax authorities, and we don't want to study this deferred tax. So there are a lot of differences when calculating profit, accounting profit and taxable profit. So therefore there will be differences on income tax payments. Sometime a company entity may overestimate the amount, or sometime low estimate, underestimates the income tax. So because of differences between accounting profit and taxable profit. So deferred tax is postponed to pay in the future. So when a company recognizes an asset or liability, it expects to recover or settle the carrying amount of that asset or liability. In other words, it expects to sell or use up assets and to pay off liabilities. So what do you mean by assets recover? So when you have asset value of 10,000, today the value of the asset is 10,000, it's mean you are going to recover this amount of 10,000 in the future periods. So it's mean you are going to get benefit of the assets. The benefit in the future you are going to receive from a particular asset is 10,000. That is recover. As far as liability concerns, so if we have liability of 10,000, in future you have to be settled that 10,000. So that's why it's called what? So when a company recognizes as asset or liability, it expects to recover. If it is an asset, it should be recover. If it's a liability, settle, right? Recover for asset, settle for liability, the carrying amount of that asset or liability. In other words, it's expect to sell or use up assets and to pay off liabilities. So if the asset value is 10,000, you can get the benefit of the asset of 10,000 while in use for the production purpose or admin purpose. Otherwise, you can recover the investment of 10,000 in asset by sell of a particular asset. So that's a way of recovering the asset. So what happens if that recovery or settlement is likely to make future tax payment larger or smaller than they would otherwise have been if the recovery or settlement had no tax consequences? So what it means here, as we discussed, there are two different types of profit: accounting profit and taxable profit. For accounting profit, we follow accounting rules, and to find the taxable profit, we have to follow tax rules. If there is no difference between these two rules, and there will be no tax imbalances, not larger or there's no smaller differences, the estimated tax calculated by the accountant based on the accounting profit is exactly same as taxable profit if there is no differences among these two. But in practical, it is not. So there's a huge differences between the calculation of accounting profit and calculation of taxable profit. So that's why the differences, the future payment of taxes may be larger or smaller because of the differences. So in these circumstances, LKAS or IAS 12 requires companies to recognize deferred tax liability or deferred tax assets. So in very simple words, I can tell you, right here, when based on the accounting profit, your profit is 10,000, for example, 10,000. Tax rate is 20%. How much tax? Tax will be 2,000. So this is accounting profits. So therefore, it will be the amount of tax estimated. But when they calculate the profit based on their tax provisions, the profit is 11,000, right? 11,000. Tax rate is 20%. So this time how much? 2,200 is tax payable. 2,200 is tax payable. So why do these differences arises? between this 10,000 and 11,000. So there are some temporary differences, or there are some fixed differences. In case of fixed differences, permanent differences, so there is no future deferred tax assets or deferred tax liabilities. But in case of temporary differences, say for example depreciation for motor vehicle and for motor car, furniture, machineries, normally the tax authorities allow 20%, 5 years depreciation rate. But the accounting depreciation may be differ, say 5% or 25% or 30% or whatsoever. It's based on the policy of the company. So due to the differences, the accounting profit and the taxable profit may be differ. Say for example here the actual tax is 2,200, but the accounting based on the accounting provisions, accounting profit, the tax is 2,000. So it's here actually we pay 2,200. It's mean we paid 200,000 excess. We paid 2,000 excess. In the next year, if we are paid excess 200, so therefore this 200 will be accounted as deferred tax asset. Deferred tax asset. It means it's a kind of overpayment. So when next year comes, accounting profit may be same 10,000 for example, and the taxable profit may be 9,900. So that time tax may be 2,000 based on the accounting profit, but tax based on the taxable profit may be 1,900. So 1,900 maybe.
Excuse me, sir.
Yeah.
Sir, can you repeat that calculation again, sir? There was a network issue, couldn't understand.
So anyhow, we will do a large calculation from this, so no, don't worry. We will repeat again in the future slides. No issue. Right, no issue. Otherwise, I will upload it. You can watch in the YouTube channel. No issue. Right. So here this 1,900 or how much, 1,800 or so. Yeah, 1,800. Here actual tax is 1,800, but based on the accounting treatment it was 2,000. So here, so when they adjusted, here already we have paid extra 200. So now we paid 1,800. So it's altogether set off the balances. Right. So if you not understand the calculation well, don't worry. In the upcoming slides, we will work out on this. Not today's session. In the next session, you will encounter with deferred tax calculations. On that slide, we can learn more. Right. Here deferred tax, here as we discussed in the last class, there are two types of taxes: current taxes and deferred tax. So current tax means, current tax, based on this example, based on the taxable income, we have to pay tax 1,200. Based on the accounting profit, we have to pay tax at 1,800, no? Yeah, sorry, 2,000. Here, the example here, for 10,000 profit, we have to pay 2,000, and based on the tax authorities provisions, we have to pay tax 2,200 in our example, right? So this is accounting profit. tax. This is taxable profit taxes, right? Here the current tax the current tax is the amount actually payable to the tax authorities in relation to the trading activities of the entity during the period. Here we estimated 2000, but based on the provisions of tax rules we have to pay 2200. So therefore the current tax is this value, 2200. Deferred tax is an accounting measure used to match the tax effect of transactions with their accounting impact and thereby produce a less result. So there are here you can observe imbalances, no balance, right? There is an imbalance between the taxes calculated based on the accounting profit and taxable profit. So the accountants need to be this sort. Accountant should resolve this imbalances. So how he can resolve it? Here he can put, basically he can do like this. The actual payment of tax is 2200, but based on their accounting the tax is 2000. So how much difference here? How much difference? Can you understand?
200, sir.
Yeah, 200. So is we have to pay overpayment or less payment we made, the entity made?
Entity made less payment.
No, entity paid overpayment. So actual payment is 2200, but already a company estimated to pay 2000. It's underestimation, right? So they are now they pay 2200, right? So excess payment is 200. So excess payment mean asset or liability? Overpayment by the entity. It's a liability. Overpayment. So this example may confuse you, I think, right? I will do the example in another way around, right? Accounting profit, say 10,000, and the taxable profit is 8,000, right? The tax rate is 10%. Tax rate is 10%. So accountant estimate how much? Accountant estimate the tax equal to how much?
1000.
But the tax authorities calculate how much?
800.
800. Right. The accountant already make arrangement for payment for 1000, but the actual payment is 800. Now it's mean, in simple words, the entity expect to pay 1000, but the tax authorities wanted to collect us how much? 800. So there's a saving. How much saving? 200. It's mean in the point of view of the entity. So no, but in future, so they can't be happy. This company, the entity, cannot be feel happy, because in future this saving should be paid to the tax authorities. So how much saving? 200. This 200 should be paid in the future. So it's the saving is a liability or asset?
It's a liability.
Why, sir, we have to pay the 200 for tax authority? We have tax authority's tax calculation is only 800, no, sir.
Yeah. Here, for example.
But accounting
Yeah. So a good question, right? I for to answer that question, I ask another question to you, right? A counter question, right? Normally, so what what are have you studied the income tax in a taxation? Have you studied? Have you studied taxation?
Yeah, sir, we studied.
Yeah. So it's easy for me, right? And when you calculate the depreciation, the capital allowance. Have you studied capital allowance? Capital allowance.
Yeah.
Yeah. So what is the
Yes,
major?
sir.
Yeah. What is the major reasons between major reason for the differences between accounting profit and taxable profit? Capital allowance, no? Isn't it? There are some expenses are allowed to deduct. There are some expenses are not allowed to
Yeah,
deduct.
capital allowance is also reason.
Yeah, it's the most important reason, no? So when you compare the figures, the percentage wise, almost more than 50% of the differences arises due to the differences between the difference between the capital allowance and the accounting depreciation, isn't it? Yes or no?
Sir.
Yeah. So normally what they do is the capital allowance normally higher rate than accounting depreciation, isn't it? So for example, in case of machineries, motor vehicle, furniture, what's the tax rate? What is the capital allowance rate? So 5 years, no? Depreciation, how many years? So I can
5 years, 20%.
20%, but if the company policy is to depreciate the asset over 10 years,
then
what
10%.
10%, then so when allocate, so when we prepare the taxable profit calculations, so we allocate more depreciation, no? It's been capital allowance, then
Yeah.
then our profit will be lower state, underestimated, isn't it? So we are deducting higher rate of depreciation. It's mean our expenses is higher than our accounting profit, accounting depreciation, isn't it?
Yeah.
So
So
due
accounting profit will be higher, taxable profit will be lower.
lower. So in that time, so income tax payment will be lower.
Yeah.
In the future, what will happen? In the future, so end of you can enjoy this lower income tax up to 5 years, isn't it? Because of that, the first 5 years you can enjoy higher capital allowance. After 5 years, what will happen?
We should pay the more taxes.
Yeah, the government or tax authorities will not allow to deduct accounting depreciation as an expenses. So therefore, your accounting profit will be higher than, sorry,
The taxable.
yeah, no, your accounting
Taxable profit is higher than.
yes, exactly. So that
accounting
time,
profit.
yeah, that time you have to pay more tax, isn't it? Taxable profit may be high, will be high.
Yeah.
So that time you have to
Yes.
pay more tax,
More tax.
more taxes. So that's a liability, no? So in this example, the 200 rupees is saving, no? It's a kind of saving, but this saving will be paid off in the future. So here we have differences, no? 10,000 accounting profit, 8,000 is a taxable profit. So then we assume that the reason for the difference is maybe the capital allowance differences, right? Have you got the point?
Yes, I got the point.
So
we should assume as a capital allowance, and future that should be paid.
it should be paid.
And it should be as a liability.
Yes. So even though we are paying less amount of income tax, anyhow we have to pay that in the future. So therefore, the company should treat it as a liability. Got it?
Yes, sir, got it.
Yeah. Here the current tax is the amount actually payable to the tax authorities in relation to trading activities of the entity during the period. So it's in this example, this 8,000 is the 800 is the taxable current tax. Deferred tax. So how much difference here? Tax difference how much?
200.
That 200 will be considered as a deferred tax. Deferred mean future tax, right? This is current, this is future. Future tax is 200. Then how much total tax?
Total tax is 1,000.
So it's mean they are indirectly emphasize that accounting is always correct. Accounting is always correct, but they can't say explicitly. So that's why they are telling a total tax. There is no word here in the LKAS 12. There is no word called total tax. So they are differing only current tax and deferred tax. This 200 equal to deferred tax. So total tax is 1,000, but nobody is telling like that. Right? Here deferred tax is the accounting measure. No, it's an accounting measure. There is no provisions in the Inland Revenue departments. It means there is no provisions by the tax authorities regarding this deferred tax. They are not worried about deferred tax. The accounting people, it means the entity will be worried about the deferred tax. The tax authorities will be worried about interest about current tax. So even though it means deferred tax means a liability, sometimes it may be the asset. So in the previous example, the accounting profit is less underestimated. So due to that, deferred tax assets may be arise. So it's mean advance payment, overpayment. So deferred tax is an accounting measure used to match the tax effect of transactions with the accounting impact and thereby produce less distorted results. Here, so even though the entity estimated the tax is 1,000, but actual payment is 800,000. So there's an imbalance, no? There's an imbalance. So to rectify that imbalances, they have make a provision of deferred tax as a liability. Right? So the double entry is okay, balanced. So in the view of tax authorities, no issue, as well as the entity's view also no issue. So here, even though there's a differences between actual payment and the estimated payment, the entity will record for their value, but they record as actual current tax and deferred tax. So this 1,000 will be divided into current tax and deferred tax. Deferred tax arises from differences between profit calculated for accounting purpose and profit for tax purposes. So that's why in taxation you normally adjust net profit. You adjust net profit into taxable profit, isn't it? In that way you have did the calculation, no? Have you done the company taxation? Have you studied?
Yes, sir.
Then it's easy, no? It is very easy for you. Right. Differences may arise from temporary differences, permanent factors, temporary factor or permanent factor. Right. For example, fines and penalty and legal expenses. These are these expenses deductible or not deductible when arriving taxable profit?
Not deductible.
Yeah, not deductible, right? Not deductible expenses. Therefore, so even in the future, are there any impact? Is there any impact on the future profit? No, there is no impact. The penalties, legal expenses, fines, so that is for a particular period, not like the depreciations, not like capital allowances. The capital allowances, the history, the story will be continuous. But in case of expenditures like penalty, fine, donations, it will be not carried forward to the next year, isn't it? So that kind of factors called permanent factors. Permanent factor. So capital allowances, it will impact on the future profit. So that's called a temporary factor. So differences between accounting profit and taxable profit may arise due to permanent differences and temporary differences. We not pay much attention on permanent differences because where an expense charged in the income statement is not allowed for income tax purposes. Can you say some other examples for permanent differences? It means what are the other expenses that cannot be deductible as an expenses when arriving the taxable profit? Can you say some examples? I can say donation, fine, penalties, legal expenses. Then what else? What else? Entertainment expenses, some advertisement cost for traveling. What else? Bad debt.
50% of telephone charges.
What about bad debt is allowable expenses or not allowable expenses? Bad debt.
There is two cases now, sir.
Yeah.
In one case,
Employee loan. For employee loan. Employee loan. In case of bad debt regarding employees loan. And other expenses. So these are the examples for permanent differences. So temporary differences. So where expense charged in the income statement is allowed for income tax purposes as well, but there's a differences in timing of such allowances. Normally we prepare financial statement. It means when we are arriving accounting profit, we follow accrual basis, isn't it? Accrual basis. When we prepare, when we calculate a taxable profit, normally we follow accrual basis or cash basis. Taxation you have prepared on cash basis or accrual basis. On which basis? Accrued income, accrued expenses, you have made adjustment for that. Bonus receivable, what happened? Bonus, cash basis or accrual basis? For bonus?
Bonus is a case basis. When we receive only, we enter it.
Yeah. Then bonus payable?
Bonus payable is not included, but salary is accrual basis.
Yes, here some expense here. Yeah. You can find the.
Both are available.
Yeah, right. That's the point I wanted. When you are arriving accounting profit, it's purely accrual basis. Agreed or not?
Yes, agreed.
Yeah. When you arrive taxable profit, you have both accrual basis as well as cash basis.
Yeah.
So due to that, there are chances to arise the differences. I agree. So the
Yes, sir.
yeah.
Agree.
So the differences arises due to three reasons. The first reason is what, temporary differences. For example, what, capital allowances, depreciation rate, right? Depreciation rate. The second one, some expenditures are allowable, some expenditures are not allowable, right? The third one, cash basis and accrual basis. So these are the differences. These are the causes of the differences. Got it? Right.
Yes, sir, understood.
Yeah. Where temporary differences, where an expense charge in the income statement is allowed for income tax purposes as well, but the differences in timing of such allowances. So, for example, bonus is a timing differences. Uh, uh, accrued income, so interest receivable. So there are some examples. We will do some examples. When we encounter with examples, we will make more clarity on this. Here, deferred tax arises due to two reasons, as we discussed, permanent differences and temporary differences. The permanent differences, so this occurs when certain items of revenue or expense are excluded from the computation of taxable profit. For example, entertainment expense may not be allowed for tax purposes. Likewise, donations and provisions. So temporary difference, our focus will be totally on these temporary differences. So this occurs when items of revenue or expenses are included in both accounting profit and taxable profit, but not in the same accounting period. So it's because of cash basis and accrual basis. For example, an expense which is allowable as deduction in arriving taxable profit for 2017 might not be included in the financial account until 2018 or later. In the long run, the total taxable profit and total accounting profit will be the same. So as we explained in the last example, last sum, in the long run, the total taxable profit and total accounting profit will be the same, except for permanent differences. We are not considering about permanent differences. That is, permanent difference means that is permanent. There is no future tax implication on this. So the timing differences originate in one period and are capable of reversal in one or more subsequent period. So this arises due to the differences between the capital allowances and accounting depreciation. So normally when prepare the taxable profit, when we do calculation to arrive taxable profit, normally government give us accelerated capital allowance. It means the capital allowance rate is higher than the accounting depreciation rate. So due to that, in the beginning period, the entity pay less tax, but that less tax will be reversed in the future period. So deferred tax is tax attributable to temporary differences, right? So the differences arises due to the temporary differences, so that temporary differences will cause deferred tax. Key definitions: the tax base of an asset or liability is amount attributed to asset or liability for tax purposes. So tax purpose, it's very important, tax purpose. Here, carrying amount, how to calculate carrying amount of an asset? How to calculate carrying amount of an asset? For example, machinery. How to calculate carrying amount?
Cost minus provision of depreciation.
Yeah, cost minus accumulated depreciation, isn't it? Then
Yes.
the balance, for example, 10,000 cost, 2,000 accumulated depreciation. How much balance? 8,000. So what does it mean? What does it mean? 8,000 mean what? The entity will get future inflow, future benefit of 8,000 from the asset, isn't it? Yes or no? Right. So the same word, same phenomena will apply in the tax purpose. Here in the tax purpose, we deduct not accumulated depreciation. We deduct accumulated capital allowances. Accumulated capital allowance. For tax purpose, we say tax base. For accounting purpose, we say carrying amount. So what's the difference between those two? So when we say carrying amount, we call cost minus accumulated depreciation. When we say tax base, simply cost minus accumulated capital allowance. That's the difference, right? In the tax authority's point of view, how much future economic benefit, right? Got it? It's very difficult. It is very, very difficult terms to understand. So anyhow, I do my best to make you understand. Right. Tax expense. Tax expense is what's a tax expense? The amount of tax you have paid, or the amount of tax the entity has paid. The tax expense comprises current tax, current income tax, plus deferred tax expense. So as I mentioned as a total tax, but here mention tax expense. Tax expense equal current tax plus deferred tax. So the accounting, the entity all the times recorded tax expense, but it's divided into two parts, that is current tax plus deferred tax. Income tax means any taxes on profit and gains payable by the entity, including corporate income taxes and capital gain taxes. Corporate tax plus capital gains. Temporary differences. Temporary differences. Temporary differences are the differences between carrying amount of an asset or liability in the statement of financial position and its tax base. Carrying amount we can find in the balance sheet. Tax base, that's prepared for tax purposes. You can find it in the calculation of income tax statement. Tax base. So temporary differences arises due to what? Due to what? The carrying amount and tax base differences, right? So temporary differences may be either, right, A, taxable temporary differences, B, deductible temporary differences. So as I told you earlier, there are two things. When an entity pays underpayment, is, for example, the entity estimated 1,000 as an income tax, but actual payment current tax equal 800. So it's a asset, it's a deferred tax liability or deferred tax asset. The 200 less payment 200, it's a liability. So that liability is coming under situation A, that is taxable temporary differences. In case of overpayment, deferred tax assets, so that occurs during deductible temporary differences, right? So please concentrate well. So it's very difficult to understand the differences, but read several times, you can get the idea, basic idea, right? So taxable temporary differences, which are the temporary differences that will result in taxable amount. That will result in taxable amount in determining taxable profit of future periods when the carrying amount of the asset or liability is recovered or settled. So the taxable temporary differences causes deferred tax liabilities. Deductible temporary differences, which are temporary differences that will result in amounts that are deductible. So earlier amount, here taxable amount, here its impact on amounts that are deductible in determining taxable profit of future period when the carrying amount of the asset or liability is recovered. So it's little bit tricky to understand the concept. Anyhow, we will do some calculations from which we can understand the differences. What is taxable temporary differences, what is deductible temporary differences. No worry at this moment. Deferred tax liabilities are the amount of income tax payable. Here, right, the liabilities, we are talking about deferred tax liabilities. Deferred tax liabilities are the amount of income taxes payable in the future period in respect of taxable temporary differences. Here it's a residue to what? Taxable temporary differences. Here you find taxable temporary differences. So deferred tax liability arises due to deferred tax liabilities. So taxable temporary differences causes deferred tax liabilities. Then deferred tax assets, that are the amount of income taxes recoverable. Recoverable mean we already paid a high amount of tax. We already paid high amount of tax. So in the initial example, we estimated 1000, but current tax payable 1200. So it's an overpayment. So in the future it will be recovered. So therefore we call it deferred tax asset. So deferred tax assets are the amount of income tax recoverable in the future period in respect of. There are three reasons. So first reason for the deferred tax asset is deductible temporary differences. Deductible temporary differences. Second one, the carry forward of unused tax losses. Carry forward of unused tax losses. Have you studied unused tax losses? Normally when entities earn profit, it will pay tax to the government, and if the entity end up with loss, the government will give some sort of what do you call, tax credit. No, not tax credit, that's different. What do you call? Carry forward of loss, carry forward of business losses. So due to that also deferred tax asset will be arises, and carry forward of unused tax credits. Tax credits also will be cause the deferred tax assets. The recognition of deferred tax is based on the statement of financial position orientation. It's a balance sheet view. Deferred tax. So where you can find deferred tax asset, where and deferred tax liabilities, where you can find it? In the financial statement. Where you can find? In the balance sheet, under the current assets or current liabilities, you can find deferred tax assets. Deferred tax asset you can find under the current assets. Deferred tax liabilities you can find under the current liabilities. So it's a balance sheet view, balance sheet orientation. So based on the orientation, see in balance sheet orientation, deferred tax liabilities are recognized for taxable temporary differences. Here deferred tax liabilities are recognized taxable temporary differences. Deferred tax assets are recognized for deductible temporary differences. Here there are two types of differences: taxable temporary differences, deductible temporary differences. Deductible temporary differences causes deferred tax assets, and taxable temporary differences cause deferred tax liabilities. So deferred tax assets are recognized for deductible temporary differences, the carry forward of unused tax losses, and carry forward of unused tax credit. Now we move to the calculation part, I think. Right, tax base, very important thing, right? Tax base. So tax base of an asset. We will talk about asset. How to calculate tax base of an asset. It is easy, right? No issue. So the tax base of an asset or liability is the amount attributed to that asset or liability for tax purposes. So tax base in accounting point of view we call as what? Accountant's point of view. Tax base, accountant point of view, it's a carrying value, carrying amount, or carrying value, or carrying amount in the view of accountant entities. In view of tax authorities, it's called tax base. Tax base equal cost minus accumulated capital allowances. The tax base of an asset is the amount that will be deductible for tax purposes against any taxable economic benefit that will flow to the entity when it recovers the carrying value of the assets. So where those economic benefits are not taxable, right? This is point 1. So this is how to calculate the tax base. And second point, where those economic benefits are not taxable. For example, some assets are not taxable. For example, tools. Is it taxable? Are there any capital allowance for tools? Have you studied taxation? Have you studied? No? So there are some assets. For that assets there is no capital allowances. Motor car used for traveling purpose of managers, executives. Motor car, are there any expense? Are there any capital allowances? Unqualified building. There are two types of buildings: qualified building and unqualified building. So where those economic benefits are not taxable, the tax base of the asset is same as carrying amount. Same as carrying amount. You have to remember these things when you decide the tax base of an asset. The third, there are two conditions under the assets. There are two conditions under the assets. First one, the tax base of an asset is the amount that will be deductible for tax purposes against any taxable economic benefits that will flow to the entity when it recovers the carrying amount. That's a normal formula. Second one is when those economic benefits are not taxable, the tax base of an asset is the same as its carrying amount. So where carrying amount and tax base of the assets are different, the temporary difference exists. For example, if there is no difference between carrying amount and tax base, or there is no difference between accounting depreciation and capital allowance, then there is no any temporary differences, right? There is no temporary differences. Say for example, if tax authorities instruct to all the entities, you have to pay tax based on the accounting profit. You have to pay income tax based on their accounting profit. Are there any differences? Are there any space for deferred tax asset or deferred tax liabilities? Are there any needs for that? Are there any necessity for that? No. So why we study this? Because of there is a difference between accounting profit and taxable profit. Right. Now we discuss about the liability. Tax base of a liability. In case of a liability, the tax base will be its carrying amount less minus any amount will be deducted for the tax purposes in relation to the liability in the future period. For revenue received in advance, so this is another circumstance. Revenue received in advance, the tax base of the resulting liability is its carrying amount minus any amount of the revenue that will not be taxable in the future period. Right? You may confuse about it. So when you look at this slide, all of your confusions will be go out. I think so. I hope so. Right? Here there are some items. Here items first, property, plant, equipment. So what's the carrying amount? Carrying amount in the statement of financial position, very simple, very straightforward. Carrying amount equal cost minus accumulated depreciation. So with regard to the PPE, the tax what's the tax rule? Attract tax relief in the form of tax depreciation. It means capital allowance. Capital allowance. So there's a difference. So there's a difference between accounting depreciation and tax depreciation, capital allowance. So due to that, the tax base in the tax account, tax base equal cost minus accumulated tax depreciation. Right? So very simple. Right. When you come to the accrued income means income receivable. Income receivable is kind of asset. So here the carrying amount in the balance sheet included in the financial statement on the accrual basis when is receivable, right? So the accountant will recognize as income throughout the period. He is no need to wait until it receives, but when it treated as on case basis, the tax base will be zero. So chargeable for tax on a case basis, that is when it is received. So here it is different. Accrued income is on accrual basis and the accrued income is treated in the tax accounting in cash basis. So that's a difference. So this time tax base is zero. So what's the reason? Reason is remember this is the carrying value in the tax accounts. We are dealing with tax account. So this amount is not yet received. So in the tax account, it doesn't know whether there are any income or not. So the tax base, there's no any economic benefit in the point of view of tax account. Remember, this is the carrying value in the tax account. As the case has not received, the income is not yet included in the tax account. So the tax base is nil, zero. So those two about accrued income. Here liability, accrued expenses. Here included in the financial statement on accrual basis, that is when payable. Accountant immediately will be recorded. He is not wait until paid on cash. So when the tax account is treated on cash basis, no, the tax base is nil. But if tax account follows accrual basis, So this time there is no difference between accounting profit and taxable profit with regards to the particular expenses. So that time the carrying amount, the tax base of the accrued expenses is equal to, so same as carrying amount in the financial statement, right? So the tax base is equal to carrying amount of a particular expenses. Now here, income received in advance. Income received in advance is kind of liability. It is a kind of liability. So when the cash is received, it will be included in the financial statement as deferred income. That is a liability. So what's the tax rule? Chargeable for tax on a cash basis. So when is received, so cash basis, so the tax basis nil. So why is that? For revenue received in advance, is a different treatment, right? For revenue received in advance, the tax base of resulting liability is its carrying amount minus any amount of revenue that will not be taxable in the future period. Here it is treated in cash basis. The entity has received income on accrual basis. No, it's a prepayment of income. So the tax authorities already deduct tax on this. So that for that income, the tax authorities not charge tax again and again. So once the tax authorities charge tax on a particular income, it will not charge tax again and again, right? So this is the summary of the slides of these two slides here. So here it's talk about assets, PPE. This asset talk about what was the economic expenses, right? And this is about the liabilities, accrued expenses, and this is about revenue received in advance. So the summary of all two slides here. So you have to remember this slide to decide a particular item is to identify the tax base of a particular item or particular transactions. So based on, keep it in your mind, the slide, based on this slide we will do some illustrated calculations, right? First one, state the tax base. So you have to find the tax base of each of the following assets and any temporary differences. And if there are any differences between tax base and carrying amount, there will be temporary differences. If the temporary differences is a liability, the temporary differences is a liability, then we call as temporary tax. What's that called? Taxable temporary differences. Yeah, taxable temporary differences. If it's an asset, we call it deductible temporary differences. Right. So first situation, a machine cost 10,000. Right. Please take a note on this. You do the calculations. You guess. I will show the answer. You guess. A machine cost 10,000 and has a carrying amount of 8,000. Carrying amount is 8,000. Means how much depreciation? Depreciation how much? How much depreciation?
2,000.
Very good. 2,000 depreciation. For tax purposes, depreciation of 3,000 has already been deducted in the current and prior period. Then how much capital allowance? Capital allowance?
3,000.
Good. The remaining cost will be deductible in the future period, either as depreciation or through a deduction on disposal. Revenue generated by using the machine is taxable. Any gain on disposal of the machine will be taxable, and any loss on disposal will be deductible for tax purposes. So we don't worry about that. So we have to worry about whether are there any differences between carrying amount and tax base. So how much carrying amount? Carrying amount of the machine?
8,000.
Then tax base?
7,000.
7,000.
There's a temporary differences.
How much?
1,000.
1,000. That's it.
Temporary differences.
So it's a liability or assets or liability? Accelerated
Liability.
is a liability. Then we call as what? Taxable.
Temporary difference.
Yes, very good. Exactly. Yeah. Now you got the point. You have got the idea about that. I'm very happy about that. Right. Second one. Interest receivable. Interest receivable is an asset or liability? Interest receivable? Asset, right. Interest receivable has carrying amount is 1,000. The related interest revenue will be taxed on cash basis. Then what's the tax base? Interest receivable, accountant has already recorded 1,000 as a revenue, but tax authorities doesn't know, doesn't care about. Then what is the tax base? What's the tax base? The tax authorities doesn't care about.
So there are no any interest receivables are there. It's a nil.
There's a nil. Right. Third one. Trade receivable have carrying amount of 10,000. The related revenue has already been incurred in taxable profit or loss. So both accountant also recorded, tax authorities also recorded. Then are there any differences?
No,
There's no differences. Then carrying amount equal. Tax base.
So
There is no tax base, and there is no any differences.
so that is nil.
Yeah, nil. Which is nil? Temporary difference is nil, but tax base 10,000. Carrying amount.
Temporary differences nil and there
No,
is
yeah. Temporary differences is nil. Temporary difference is nil. Right? And loan receivable. Loan receivable has carrying amount of 1 million. This repayment of loan will have no any tax consequences. No tax consequence. This time, here look at this one. Where those economic benefits are not taxable, the tax base of the asset is same as carrying amount. Same as its carrying amount. Then look at this. A loan receivable has a carrying amount of 1 million, and the repayment of the loan will have no tax consequence. Then how much carrying amount? The tax base?
same 1 million.
Yeah, 1 million. See the answer? Then how much temporary difference?
No any differences are there.
Yeah.
Because carrying value is equal to tax.
Yeah, exactly. Now this illustration is about Liabilities. State the tax base of each of the following liabilities and any resulting temporary differences. First one, the current liabilities include accrued expenses. Expenses is payable, accrued expenses, with a carrying amount of 1000. The related expense will be deducted for tax purposes on case basis. So accountant has recorded, but tax authority is not recorded. Then what's the tax base?
The tax base is 0, so already there is a 1000.
Yeah.
1000 is a difference.
Yeah, 1000 is a different, right? Here the tax base of the accrued expense is nil. The temporary difference will be 1000. So you can look at here. Accrued expenses. Here on case basis it's nil. Second one, the current liabilities include interest revenue received in advance. Here, interest revenue received in advance. So we have to go to this statement, this one, income received in advance. So what's the calculation? Nil. Here current liabilities include interest revenue received in advance. With the carrying amount is 10,000, the related interest revenue was taxed on cash basis. Here accountant is recorded and tax authority is also recorded. Right? Accountant has recorded interest received in advance. Anyhow, he has recorded. Tax authorities also has recorded and charge income tax on that profit. So here for this special treatment, or the treatment for revenue received in advance, the tax base of resulting liability is its carrying amount minus any amount of revenue that will not be taxed in the future. Here in this example, they already paid tax for this 10,000. So no more tax will be charged. Here the rule of thumb is what? The tax base equal to how much? 0. The rule of thumb 0 here. And third one, here you can find the tax base of the interest received in advance is nil. The temporary difference is 10,000, right? The current liabilities include accrued expenses. Accrued expenses mean what? Interest payable. Current liabilities include accrued expense with a carrying amount of 2,000. So the related expense has already been deducted for tax purposes. So what is that? Here is a liability, current liability. So accrued expense is payable. So, the carrying amount 2,000, the related expense has already been deducted for tax purposes. So here this case is become here, this one. So accountant also recorded and tax authorities also has recorded. Here the current liabilities include accrued expense with a carrying amount of 2,000. The related expenses has already been deducted for tax purposes. So how much? Here the tax base of the accrued expense is 2,000, same as the carrying value. So there is no temporary differences. And current liabilities include accrued fines. Here current liabilities include accrued fines and penalties with a carrying amount of 1,000 fines and penalties are not deductible. Then here, so this is for treatment is this, where those economic benefits are not taxable, the tax base of an asset is the same as its carrying amount. So same principle will be applied for liabilities too. So current liabilities include accrued fine and penalties with the carrying amount of 100. The fine and penalties are not deductible for tax purposes. So carrying amount is 100. Therefore, which one? The tax base also 100. Third one, so fifth one, the loan payable has carrying amount is 1 million and the repayment of the loan will no tax consequences. So it's equal to carrying amount, right? Tax base of the loan is 1 million, no temporary differences. Circumstances in which the carrying amount of the asset or liability will not be equal to its tax basis. So these are the circumstances where the tax base and carrying amount are not equal. Circumstances in which carrying amount of assets or liability will be equal to its tax basis. IAS 12 gives the following examples of circumstances in which the carrying amount of asset or liability will be equal to its tax base and no temporary difference will be arises. Accrued expenses, so very easy, but accountant also recorded and tax authorities also recorded, and there's no differences. So accrued expense in which have already been deducted in determining entity's current tax liability for the tax for the current or earlier periods. The loan payable, which is measured at the amount originally received, and this amount is the same as the amount repayable on the final maturity of the loan. Accrued expenses, which will never be deductible for tax purposes, for example, donation, entertainment expenses, penalties, fines. Accrued income, which will never be taxable. So these are the things. So this is the final formula. You can try on this also. So I have given how many examples? 4 plus 5. So 9 examples. You can apply these formulas. So a tax base of an asset. So this is the formula: current value minus carrying value minus future taxable amount and future deductible amount. So there are, so this is what the definitions given, right? And the earlier we have studied definitions. Here, this is the definition. So you can find the same thing here, right? So tax base of an assets, tax base of a liability, tax base of revenue received in advance. So it's up to you. So you can, if you understand this formula, then no need to remember this slide. If you remember this slide, then you don't need to worry about this slide, right? And I hope all of you got the point.